Welcome to the Leverage Living podcast with Ryan and Bryce. We are excited to do our first deep dive episode today, and we're going to talk to you a little bit about something you've heard on both of our weekly updates, which is an SPAC or SPAC, SPAC, Special Purpose Acquisition Company. There's a lot of different ways to describe this structure. Before we get into it, Bryce, what are you using to stay hydrated for this deep dive?
Ooh, my hydration of choice here is a nice Maker's Mark.
Wow.
With some orange bitters in there.
That's
kind of the same as last episode. Let's give her a taste, see what she's all about. A nice little citrus taste to the tip of the tongue. What about you? What are you sipping on?
So I'm going with a classic fall beverage, the Fireside Flannel.
Ooh, that sounds comfy.
Yeah, it's literally a wool sweater with a fireplace in your mouth.
Yeah, sounds itchy.
With great fall foliage. So
I love some foliage, especially this time of year.
It tastes like North Shore foliage.
Oof.
It's crisp.
Say it ain't so. Let's go.
So, well, let's get us started. You've heard us talk a lot about SPACs. So what are those? I mean, you've heard about stocks, you've heard about investing. What are these things, SPACs, that the Leverage Living guys are talking about? So to go into a specific definition, a SPAC, S-P-A-C, is a special purpose acquisition company. Sometimes you'll hear people call them a blank check company or a shell company. So this is a structure that has no operations, but it's formed with the plans to go public and merge or acquire an existing company using the proceeds of the SPAC's IPO. So this is essentially a trust that's created. You can think of it like where, if Bryce and I were going to start our own SPAC and we were going to take a company public, we'd maybe put in $100 million. We'd target a company of a certain size. So we'd each throw $50 million in there. And that money's sitting in there in cash, maybe in T-bills, until we find an acquisition target. So what SPACs do, and the reason we really love them, is they allow retail investors to invest in private equity type transactions, particularly leverage buyouts, which typically the retail person doesn't have access to. So in my opinion, it democratizes the initial public offering process, and it allows guys like Bryce and I, and who's ever listening, to get in on the action before this company actually become public. So it's specifically created to pool funds in order to finance a merger or acquisition opportunity within a set time frame. So typically these shell companies, these SPACs, have a year or two to identify a candidate that they're going to merge with or acquire. And after that merger happens, the symbol of the SPAC becomes the symbol of the company they acquire. So for instance, we did one, the SPAC was VTIQ, Vecto IQ. That was the blank check company. They identified Nikola Motors, which you've heard about. You heard us talk about quite a bit on the podcast.
We've talked about them, yeah. Oh, yeah.
So once that merger was complete, the symbol went from VTIQ to NKLA and was trading as Nikola. So that's the high-level overview of a SPAC. Bryce, why don't you take us through what the management structure typically looks like?
So, the SPAC is usually led by an experienced management team. Millions of dollars don't come out of thin air. People want to have their investments trusted by somebody that knows what they're doing. So it's usually composed of about 3 or 4 members with a prior private equity. The mergers and acquisitions and operating experience are at a very high level. The management team of the SPAC typically receives about 20% of the equity vehicle at the time of the offering. In exclusive of the value of the warrants, we've seen it a bunch of times how the warrants start way, way low. And as more equity keeps getting dumped into these SPACs over and over again, we see those warrants go up at a exponential growth rate percentage wise as opposed to the actual stock price.
Yeah.
So that's pretty interesting to get into warrants, and I'm sure we'll have an episode on warrants as well, how to manage those. The equity, like you said, is usually held in escrow for roughly 2 years. And then the management normally agrees to the purchase of warrants and the units as a company. It's a private placement immediately prior to the offering. And then the proceeds from the sponsor investment are usually equal to about 2 to 8% of the amount being raised by the public offering. Those are placed in the trust as well and distributed to the public stockholders in the event of the liquidation. So there's no salaries, finder's fees, or other cash compensation that are paid to the management team other than the business combination, and the management team does not participate in any liquidating distribution. If it fails to consummate a successful business agreement, you'll get your money back at $10, or in the case of
10, 20.
Yeah, Bill Spackman, it'll be about 20. In many cases, the management team agrees to pay for the expenses in excess of the trust if there is a liquidation of the SPAC because no target has been found. So like I said, you'll get back your 10 or, PSTH 20. Conflicts of interest are minimized within the SPAC structure because all the management teams agreed to offer the suitable prospective target business agreement to the SPAC before any other acquisition fund. So they're subject to pre-existing fiduciary duties. The SPAC is further prohibited from consummating a business combination with any entity affiliated with an insider unless a fairness opinion from the independent investment banking firm states that the combination is fair to the shareholders. So that's where we go back. We see that FMCI, you have to vote. All the shareholders can vote to see whether or not they want that transaction to pass through or not. They need that 65% vote to be positive for it to continue on in the process.
And so a good example of the last sentence you had said was a business combination with an entity affiliated with an insider. This is LCA. So LCA is Lancadia Holdings. It is combining with Golden Nugget. Tillman Fertitta, he's the billionaire that launched.
Makes billionaire moves.
Yep, makes billionaire moves. He launched LCA as an SPAC. He's acquiring a company he already has ownership in. So that's an entity affiliated with him. So there had to be basically an opinion from an investment banking firm that states that this is fair to shareholders, that Tillman's not just doing this to line his own pockets. So he obviously he had two options there. He could have created the SPAC, taken his online gaming company, Golden Nugget, public that way, or he could have done the traditional IPO route. So he chose to do a SPAC, and I'll walk you through a little bit about what are some of the differences. So an IPO through an SPAC is similar to a reverse merger, somewhat, if you're familiar with that. But unlike traditional reverse mergers, the SPACs come with a clean public shell company. So there's better economics for the management teams and sponsors, and there's certainty of capital in place to move forward with an acquisition. So SPACs are set up with a clean slate with the management team searching for a target to acquire, and they typically raise more money than reverse mergers at their time of IPO. So the average SPAC raised approximately $234 million compared to about $5 million raised for reverse mergers in the months immediately preceding and following the completion of their IPOs. So they also raise money faster than private equity funds. The liquidity of SPACs is very attractive for all investors, especially retail investors, because they're offered in the open market, which we spoke about. So you see a lot of activity from guys like Bryce and I, from hedge funds, from investment banks. They're very interested because the risk factors seem to be lower than the standard reverse mergers, and they allow the targeted company's management to continue running the business, sit on the board of directors, and benefit from future upside of the acquisition target. So the management team members of the SPAC typically take seats on the board, and they continue to add value to the firm as advisors and active investors. So After completion of the transaction, the company usually retains the target name, like we talked about with the Nikola example, and it will be trading on the NASDAQ or New York Stock Exchange. So from a high level, that's a little bit of the difference. But the high points to take away are it's a process that's open for retail investors. If you remember Snowflake, that went public 2 weeks ago, and IPOs usually do the roadshow to high net worth people like Warren Buffett, hedge funds. They get to buy at X price before it's even publicly traded. So Warren Buffett, this is just an example, I could look up the real numbers, but he maybe got to buy, he bought like $250 million of Snowflake at maybe $50 a share. It ended up going up over $200 a share when it went public. And, you know, before guys like Bryce and I went in, it was already priced well into the hundreds. So this allows us to get in on the ground floor. That's the appeal to these structures. So,
it levels the ground between retail investors and those high power guys like Warren Buffett. It really levels the ground for us, which is what we love so much about it.
Yeah.
And then I just wanted to touch on some cool stats for the SPAC that I thought were interesting that our viewers might like to hear about.
Yeah.
According to an industry study published in January 2019, from 2004 to 2018, approximately $49.14 billion was raised across 332 SPACs, IPOs in the United States. In that period, 2018 was the largest year for SPAC issuance since 2017, with 47 SPAC IPOs raising approximately $10 billion. And then SPACs seeking an acquisition in the energy sector raised $1.4 billion in 2018, after raising a record 3.9 in 2017. So we're seeing like a decrease there, which is interesting. But the NASDAQ was the most common listing exchange for SPACs in 2018, with 34 SPACs raising $6.4 billion. And there's the GS Acquisition Holdings Corp. And Churchill Capital Corp. They each have about 4. I know Churchill has at least 4 of their own SPACs now.
Yep.
And they raised the largest SPACs of 2018 with $690 million each in IPO proceeds. And then in 2019, we had 59 SPACs which IPO'd raising $13.6 billion. So we're assuming that the numbers are going to keep rising. In 2020, we had just one SPAC that took $4 billion. So, I mean, that's a very, very healthy percentage of everything that was raised in 2019. And SPACs have been exploding this year so far.
Yeah.
So
definitely very popular this year. And couple popular ones that are still trading today that you might own. Virgin Galactic, so SPCE space. DraftKings, that one's incredibly popular. That went public through an SPAC. Nikola, popular for a number of reasons outside of the business operations. Those are
both
probably
good and bad, mostly.
Both good and bad. Those are probably the top 3. So, Bryce, just to recap, let me ask you a couple questions. Number 1, what are these SPACs, SPACs? What do they usually trade for when they become public before identifying a target?
Before identifying a target, they'll start at $10. And there's one exception, the one I mentioned earlier, which started at $4 billion for the initial amount raised. Bill Ackman. His will start at 20 because of how he's looking for a mature unicorn, a company that's a couple that were mentioned were Airbnb, I believe Instacart, yes, Postmates maybe, was that one of them?
Robinhood could be one.
Robinhood, yes, we love Robinhood. Yeah, so all of them will start at $10, and then as an LOI comes out or a letter of intent to merge with another company, once those announcements come out, then you'll see the stock price either go up, which it has in most cases with the ones we've mentioned, at least your FMCI, Graph, LCA, DPHC, TRNE, all the good ones. Yeah, that your boys are talking about. Yeah, and then PSTH, Pershing Square Tontings Holdings, Bill Ackman, that'll be 20. But yeah, from now so far they're all been 10. Other than that one.
So next question, if let's say that I invest in a SPAC and it's been out there for almost 2 years and it
Hmm.
doesn't seem like they're going to find a target. And I know that these gyrate a little bit above, a little bit below 10. But if it's at $9.80 and they reach their deadline and it initially started at 10, what happens to my money if they don't identify a target? What do I get back?
You get your full 10 back. It's held in a trust. So if nothing happens at the end of those 2 years, you'll get, say you bought 200 shares at $10 each. Was that $2,000 if my math adds up?
It's chiropractic.
Usually, yeah. So you'll get your full 2,000 back at the end if they don't find a acquisition by the end of that 2 years.
Sure. So
you really like your downside is if you get in
limited.
early, it's very limited.
I think the only, not the only, the main risk of downside would be, so if they don't identify a target, that's liquidated. You get your money back. You have opportunity cost for those funds. Your downside were to come if they identify a target and it's wildly unpopular amongst investors. Right. If they say they want to revive Enron and bring that puppy around, and that's at $10, I mean, that's going to go to $2 pretty quickly. So,
yeah, and once they actually merge, then you're on the shtick for whatever happens after that.
Yeah. So after the merger, there's no more potential floor, potential baseline of that trust value. I mean, when that's done, you own a stock at this point. It's no longer a SPAC. There's no longer any risk mitigation. So
that's why we love to look at who's starting that SPAC. Like our boy CP Shamat. We love playing with him because he knows what he's doing. He's a smart man. He was on the ground floor of Facebook, and he's been successful time and time again when it comes to the SPACs. Yeah. So if he puts his name on one, it's a good bet.
And that's what, you raise a great point. This year, we'll see if there's some data we can share about the popularity of SPACs, but it's wildly more popular than 2019. Yes. I think, there was about 59 SPACs in 2019. I would venture to guess in the past 2 to 3 weeks, there's been over 59 SPACs that have launched. So
yeah, it's surprising how often these things come about now.
It's starting to get, a little bit like the wild west. It's getting a little crazy. So what's
saturated?
Becoming very saturated. What Bryce and I look for in the beginning, because if they don't have a target in mind, you might ask yourself, okay, what's the appeal? What do you look for? We really hone in on the management team. A lot of times there'll always be information about the management team that are looking to take a company public. So that's our primary investing criteria, is a management team that has typically experience with the SPAC structure too. There's
the ability to make good decisions is key.
And so to be well connected and to make good decisions. And there's several of those management teams out there that have taken several companies public through this structure. Mm-hmm. So those are primarily the ones we stick with when we try to get on the ground floor. So we have a large allocation to Pershing Square, because Bill Ackman, he has taken a company public before through an SPAC. He's a successful billionaire hedge fund manager. So that checks the management team box for us. Yeah, we're willing to take the ride before he's a target.
Good deal. And he came out with that. So they have about 24 months to find a acquisition company or company to acquire and merge with. And his has been around for about 2 months now, I believe. Roughly, would you say it's about right? 2 months?
Yeah, just about 2 months.
So, I mean, the rumor kind of was that he had an idea going in to what he wanted. So it probably won't take that 2 years. It usually doesn't. They're usually, when somebody acquires that much money that quickly, they have a good idea of what they're going to try to merge with going in.
Yeah.
So it pretty rarely takes the full 24 months to acquire a company.
Yeah.
in that fashion.
So
one more thing, the management team is motivated, and the company that wants to go public is motivated.
Yeah.
That makes it fly a little bit quicker.
Great point. So that's the SPAC structure in a nutshell. Please email us. We have our email below, leveragelivingpodcast@gmail.com. Please email us if you feel there's anything we missed. We'd be pleased to post an update or to respond directly to your questions. But that gives you a high-level overview of what these structures are, why we're interested in them as not only structures that have a lot of upside, but have limited downside in some cases, which is a good place to be with the volatility we forecast through the rest of the quarter. So that's our episode on SPACs. Like and subscribe below, and email us if there's any questions.
Comment around too. The comment box is open for you.
Send a few comments. Thanks for joining us, and we'll see you next week.
See you guys.